I think now somehow AI became a buzzword, but at the core, it's been an intuitive journey to lead us to using ChatGPT, having an ability on our Zoom call today to click on AI notes and not having an analyst taking notes of the conversation. And so I do welcome some usage of AI in a sense that it allows you to get a lot of information, and machine learning is analyzing that live and providing information as an output. Now, there's a massive disclaimer, though, is that one should not rely on AI only to make his own investment decisions. And as a quant manager, of course, we are looking for efficiency, ability to analyze a larger batch of information, but boy, will be in trouble if that's the only way we add value to any investor.
This is the future of finance. This episode is brought to you by Impacts Asset Management and the Intentional Endowments Network's Endowment Impact Benchmark. Hi, everyone. Welcome to the Future of Finance podcast. I'm Georges Dyer, and today we are joined by Mamadou Sarr, co-founder and president of V-Square Quantitative Management. Mamadou co-founded V-Square in 2020 after an accomplished career in asset management, working for global financial services companies across the U.S., Europe, Middle East, and Africa, including Northern Trust, where he spearheaded, developed, and led one of the largest sustainable investing platforms in the industry. In 2017, he was recognized in the top 50 individuals who contribute the most to sustainable and responsible investment industry in the world by the Independent Research in Responsible Investing Group. In 2024, he was recognized as one of Crain's Chicago Business 2024 Notable Black Leaders. We talk about what quantitative investing is, how it relates to sustainable investing, and how financial returns are at the center of their approach. Mamadou is a really smart and interesting guy, very funny as well, and it was a great conversation, so hope you enjoy it.
Mamadou, welcome. Thanks so much for joining me.
My pleasure.
How you been?
I've been good. The year has been full, hectic, balanced, scary, and interesting. These are the words I'll pick for today. But nonetheless, I've been good. Thanks for asking. And you?
That's a pretty good summary of 2024. I'm good. I'm doing well. This will probably come out in 2025, but we're recording at year end. So it's that sort of sprint to the end of the year, and busy, but all good, and looking forward to some downtime here at the end of the year.
Excellent.
But really, but really excited to connect with you and have this conversation before we do that. So just to kick us off, would love to have you tell everyone a little bit about V-Square Quantitative, just kind of briefly what the firm does.
Sure. And so I'll kind of briefly share my background because it ties up into the why. And so I describe myself as an international financier, and that's the pleasure of having three passports: French, British, and confused. The one I tend to call most days is confused. But my career has been very much of initially a random walk in Wall Street. I started 25 years ago as a currency trader for Citi, moving to the hedge fund world. I learned some techniques around quantitative finance. In the mid-2000s, I ended up connecting with the CIO and the co-founder of V-Square that you know well, Habib Mudashiru. And we kind of formulated the view that one day we'll merge our skill sets. And in a full disclosure, Habib is 10x smarter than I on my very good days. He's an actuary with physics, statistics, financial mathematics degrees. And I'm a finance and an econ guy. And we thought that we had some core technical skill sets as French quant that could be used in the markets down the road. Now, it's like anything in life, you plan for, and it may take longer than expected. We went separate ways. On my side, I ended up at Northern Trust for a long time, initially in London, then the Middle East, and then Chicago at the tail end of it. And in 2020, I decided to take a leap of faith and leave the firm to build my own investment firm and co-found it with Habib as we planned back in 2006. So a very long journey in that. All right. So what is V-Square? And it's a question that we ask ourselves way before launching the firm, with a very initial premise that asset management is a crowded field, a lot of competitors, a lot of players. There is 11,000 long-only managers. There's around 4,000 hedge funds. There's ETF providers in the mix. So why would you need a V-Square? And that question forced us to think about our unique value proposition. We wanted to be a quantitative manager because it happens to be our forte. We wanted to be unique in the delivery of services for clients by being thematic, global, right? And by having a pulse on the market and a pulse on innovation. And I know we're going to talk about it later on, but at the core of V-Square, you have a team of investment professionals who worked at large firms in Wall Street and around the world. I like to joke around and say that we made our most expensive mistakes elsewhere. before being brave enough to own some mistakes and build something separate and different. But the premise for us was a desire, burning desire to build something new in an asset management industry that tend to be very stale and very steady. So, George, in a nutshell, that's what it is. V-Square is a quant shop that covers multi-asset classes, differentiated, global, and thematic. And we're excited to talk to you today.
Cool. So I want to kind of go back to basics on what quantitative investing is. But first, what about the name? What's the origin of the name?
What's in the name? What's in the name? So, what's in the name is basically V. The letter V has could be used with so many words if you're good at Scrabble, and I happen to be a Scrabble player, so I use V quite a few times in my playout. But it's basically our value, velocity, and valor, and values in plural, and all that has different meaning. But the view we had was basically to look at each V as a corner of a square, and as you assemble them, it create a square shape, hence the name V-Square for value, velocities, and values. And so that's kind of what's in the name. It's pretty much a quant nerdy play that makes us only smile, and maybe it's the only audience that end up having a smile after that, but that's what it is in terms of the name of V-Square. What's in the name?
That's great. I've always been curious about that. But yeah, so like I said, this podcast is as much for the endowments in our network and the intentional endowments network and sort of sophisticated institutional investors, but also people interested in finance, students that might be wanting to get into this space. So give us a little, just kind of the high level, what is quantitative investing?
That is quantitative investing. And it's not a bad word. I just want to clarify that because at some point it became a bad word. It became a bad word when somehow people equate quantitative finance to high frequency trading and losses in the marketplace and computer where you click on the button and it just buys stocks without any oversight. It is pretty much a cartoon picture of what the field of quantitative finance is. The good news is that as French, I can claim that we invented the notion of quantitative finance and we have our own forte in the merit. But in the main point of quantitative finance is basically looking at the markets in the premise of risk factors. And often we tend to juxtapose two investment styles. One is fundamental. And if I were a fundamental PM, I will tell you, George, my forte is to buy the winners of tomorrow and sell the losers of tomorrow. And I built an expertise into valuation, looking at a DCF model and telling you overweight, underweight this stock based on valuation, prices, and other factors. So I'm a stock picker and I'm a fundamental stock picker. That's the story of,
looking at the fundamentals of the company and what's a good
exactly, balance sheet analysis and so on. As a quant, I'm actually more skeptical of that. And I will tell you, I believe that markets are efficient on average, and I can decompose the returns into compensated risk factors. And they are the beta of the markets are growth, value, volatility, quality as a factor, and momentum and other type of factors, right? So in the school of thought of research, Femme French kind of led the way with a multi-factor model. And then that's what quantitative finance is at V-Square. We are looking at how to decompose investment returns into systematic risks and how to harvest the cyclicality of the factors to deliver better risk-adjusted performance for investors.
It makes some sense to me. And I'm really curious how that shows up. We're all focused on sustainable and impact investing at IEN. And this is kind of investing in what is a big transition and in some companies and markets or sectors that are quite nascent, where you're looking at renewable energy and the like. And so curious just, how your strategy ties in sustainability and if some of those factors are different in the quantitative models.
And so sustainability has such a broad application as per se. It comes from the Latin word sustenere, and it means to be here in the long run. Arguably, any type of investment should be sustainable. That's my first point. The same way that we hope that every investment can remain sustainable and be at vitam aeternam, or meaning in the long run. That's just the premise of it. Somehow, we narrow down the scope to a subset of sub-strategies that we deem are sustainable, okay? And then it tends to be more on the environmental side or other part of what was the acronym ESG. I use the past tense because I believe that the term is due for a proper reboot, but not so much the view that companies should be mindful of negative externalities to generate better investment outcome for whomever is buying or selling the stocks. That's one. Now, the dichotomy that becomes a conversation point is about what is the purpose of a company. Is the role of a company to only deliver value for shareholder, so what we call shareholder value, or is the role of a company more complex and serve a broader audience, what we call the stakeholder? And I think the tension point that we see in that market is pretty much a tension point about the purpose of a company and outcome for investors. So the shareholder primacy led the notion of capitalism because you are borrowing money to generate more, and then you are meant to return investment to whomever put some chip in and bought some stocks or even financed your company. We can all agree on that being an expectation that is fair. Now, the broader scope around stakeholder includes employees, includes community, include obviously the shareholder that is still part of that, but the broader stakeholder stack. And so why do I believe that having a systematic approach makes sense to look at companies holistically? It is because it's about data analysis. And the value of quant is that it allows you to look at a large set of information to make better investment decisions. Okay. So let me kind of go through the process of it. So let's say that we think that looking at for oil and gas, how much of the capex is spent on renewable energies or other elements of healthcare around safety and so on. So these type of information 15 years ago were not part of any type of analysis as per se. But nowadays you have that information easily readable in the marketplace. And having a quant approach allow you to decipher the data, harmonize the data to compare that for likes, and then normalize it, meaning that you can use that with the same denominator to make investment decisions. So we actually wrote an op-ed by claiming that quant should speak sustainability as it's a foreign language and that they master, and they should be actually arguably bilingual in it because it allowed you to make better investment decisions. So in a nutshell, I believe that it's an appropriate approach to market and to deliver investment returns for the buyers.
This episode is made possible by Impacts Asset Management. Founded in 1998, Impacts is a specialist asset manager investing in the opportunities arising from the transition to a more sustainable global economy. Impacts offers a well-rounded suite of investment solutions spanning multiple asset classes, including equities, fixed income, and private markets, seeking strong, risk-adjusted returns over the medium to long term. For more information, visit impactsam.com. That's IMPAXAM.com. This episode of the Future of Finance podcast is brought to you by the Intentional Endowments Network and our new Endowment Impact Benchmark, which is an exciting new initiative helping endowments and foundations measure their progress on sustainable investing. Participants receive expert feedback, the ability to benchmark against peers, and earn recognition for their leadership. If you're at an endowment or foundation that is ready to advance its sustainable investing strategy, or if you want to benchmark your progress against the field, or if you're looking for a credible way to show your stakeholders that you're taking these issues seriously, learn more and join the 2025 cohort at endowmentimpactbenchmark.org.
I'm curious, is AI a part of your work or increasingly, or what role do you see AI playing in all this as we have more data?
Sure. And I think now somehow AI became a buzzword, but at the core, it's been an iterative journey to lead us to using ChatGPT or having an ability on our Zoom call today to click on AI notes and not having an analyst taking notes of the conversation. And so I do welcome some usage of AI in a sense that it allows you to get a lot of information, and machine learning is analyzing that live and providing information as an output. Now, there's a massive disclaimer, though, is that one should not rely on AI only to make his own investment decisions. And as a quant manager, of course, we are looking for efficiency, ability to analyze a larger batch of information, but boy will be in trouble if that's the only way we add value to any investor. So we use that as a way to gauge, analyze, and be part of a process, but by no mean, and I do insist on the term by no mean, it is the tool to buy or sell securities or even make your own investment philosophy and decisions.
Yeah, no, that makes sense. I mean, my sense is it's going to be increasingly integrated into everything, but yeah, it's not core to your model, I guess. It's not an AI strategy. Got it. And so what types of investors typically are you working with? Who's finding this kind of approach attractive?
So we are thematic managers, meaning that we have a broad investment platform that span across cash management, treasury bills and the likes, ultra short, long duration on the fixed income side. And on the equity side, we are a multi-asset class. So we are actually managing US large and mid and small, and also world developed stocks, right? So the entire kind of coverage is there. And the sub asset class we have as well is called listed real assets. And so for us, the bucket has twofold: listed infrastructure as one, and the second one is actually natural resources. So think about V-Square as a multi-asset class thematic manager that cover fixed income, equity, and listed real assets. Now, under the
Public market though, right?
all public market though, right? We're not in private market or venture and that's it. Now, part of the thematic offering that we have clients asking us for AI and robotics on one side, or global mobility exposure on the other side, or the future of education could be an example. And we have clients asking us for sustainable companies exposure through the lens of equity or fixed income or listed real assets. Okay. So our clients tend to be institutional. If I look at the book of business we have at V-Square, the bulk of it is institutional, with a double click on foundation, endowments, and public points. That'll be in my first bucket of clients. The second bucket is what we call intermediaries, and they tend to be financial services companies that are selecting managers on behalf of their clients. So the term we use in the market is managers of managers, or OCIO, outsourced chief investment officer, or officers to that extent, that select on behalf of an asset owner. And the last but not least, we have a wealth management practice where the end clients tend to be individuals, family offices, and also ultra high net worth individual in the process.
This episode of the Future of Finance podcast is brought to you by the Intentional Endowments Network. Yes, that is the nonprofit that I lead. And also our new Endowment Impact Benchmark, which is an exciting new initiative helping endowments and foundations to measure their progress on sustainable investing. Participants receive expert feedback, the ability to benchmark against peers, and to earn recognition for their leadership. If you're at an endowment or foundation that is ready to advance its sustainable investing strategy, or if you want to benchmark your progress against the field, or if you're looking for a credible way to show your stakeholders that you're taking these issues seriously, learn more and join the 2025 cohort at endowmentimpactbenchmark.org.
So it's applicable to quite a wide range of investor types.
It is.
Even down to
and that was always
individuals,
the purpose of V-Square. Our goal was to be a fully fledged investment firms with the core expertise as being quant and thematic that serve both wealth management and institutional.
And do you find that most of those investors are coming because of the sustainability focus or because of the financial performance or some combination, or is it varied between one type or the other?
So for me, the end of quarter review is always what tells you exactly what the clients are expecting. They come to us because they expect strong performance and has a decent level of fees. And so I'm not different than any other manager. So I'm judged on the same, let's say, metrics that are pretty much quarter to quarter risk-adjusted returns and volatility and so on. That's the first statement. Now, having said that, the fact that we are thematic and quant, and we have unique capabilities that cannot find in other competitors, makes us a choice in that ecosystem of managers, right? So typical example, we'll have a foundation that comes to us and say, Mamadou, we're looking for a strategy that reflects our values as a foundation. This is our mission statement. This is the audience. This is our brand making. Can you create something that is bespoke and also deliver the return that we're hoping for? And we have the ability to customize portfolios for clients, take on board their preferred exposure, and all that using a digital tool. Because there's something fascinating about being a new entrant in the marketplace is that you benefit from the last mover advantage. As I mentioned, we've been at it for a quarter century in managing money. But then as you launch yourself in a market that is more focused on delivery of technology, we've used that advantage to be able to offer a questionnaire that help clients define their portfolio, take that as an input, and then put a proposal in front of them in a very short timeline and manage their money accordingly if they were to trust us for that exercise.
Gotcha. Very cool. And what are you seeing? Are there any trends there? I mean, are a lot of investors looking for exclusions just to avoid companies or sectors that they think are bad, or looking to invest in solutions, or some combination?
So my answer would be the following. It all depends on the end clients. I will say that value-based, and I'll even use the plural of it, values expression ranges from everything. I can have a client that tells me, I would like to have all the companies that are fossil fuel heavy, and then tell me what do you think about it. Now, I will tell him as an investor, I don't think it's a good idea, just from a pure direction of travel. Okay. But then I have clients who are coming at it with the view that they are a foundation or an endowment, and this is the IPS, their policy statements, and they're looking for a match across asset classes. And so our ability to customize, our ability to listen, and also to innovate is a forte of V-Square. And therefore, they tend to come to us to have a solution that could be very much in line with their IPS or their what they're looking for, right? Now, from a range of delivery, we are managing what we call enhanced equity in active portfolios, but we also have some passive capabilities if a client is just looking for broad market exposure, if that makes sense.
Yeah, for sure. And are you seeing trends though in terms of what types of issues are a lot of,
Yeah.
is climate a big focus? What other issues are top of mind for
Top of
investors that you're
mind for
seeing?
investors, I'll say climate is top of mind with a massive disclaimer is that you are trying to solve a macro issue by looking at the lens of a short-term quarter-to-quarter investment portfolios. So is it correlation? Is it causality? What are the ramifications? My big statement is that we have to be careful when we use climate as a lens to make short-term investment decisions, because these type of issues tend to pan out over the medium to long run. And also it could be a zero-sum game because it requires multi-stakeholder to that extent, public and private, to actually work in tandem. And then you also have the supranational entities, the organizations such as obviously the UN and so on, that are working towards climate outcome. For me, though, if I were my risk hat on and I were to assess, do I believe that climate risk has application into managing equity and fixed income instruments? My answer is yes. And I will tell you why. If you look at a value at risk measure, which is a very typical measurement of risk that we use in asset management, you could use a climate VAR and define exactly to the decimal what value is at risk in your portfolio as you hold these equities or these fixed income instruments that needs to be carefully managed or diversified away. That's why I think that comment to the lens of risk management is very critical in any type of portfolio. So climate VAR that has been in the market for now a few years, and a lot of risk tools have a section called climate VAR today. And it was a very novel concept a few years ago. So climate top of the line based on what I look at from a risk management perspective. Now, other themes that I think are critical, one is biodiversity. Arguably speaking, though, biodiversity is hard to narrow down into buying and selling stocks. I must say that I think there is better application of having a true impact on biodiversity through the private market lens as opposed to public markets. And you're starting to see some very interesting venture funds focusing on biodiversity and doing amazing work in that. So I'm not kind of just wearing my own shingle here. I have to say that sometimes the best impact are achieved in the private markets, and it requires capital mobilization and put a stack from venture to later stage type of companies that could add that. So first climate, then the biodiversity will be a second layer. And what I've seen as another kind of topic that people are grasping their head around, it's around the notion of value creation And it ranges from employment, it ranges from youth, mental health issues, and a lot of other elements that we may think is remote from investing, but it's actually not remote from the term of investing. And my take is that with the wealth transfer that we are seeing happening and unfolding in the US, topics are likely to become more front and center in the minds of investors.
The wealth transfer from one generation to the next.
Exactly. Yeah.
Yeah. Yeah. Yeah, no, that makes sense. And there's so many factors here, but I'm curious, coming back to what you said about climate being a macro issue, and it's really the systemic risk. And in some ways you can address that risk in your portfolio, as you're saying. But I'm just curious, separate from V-Square, like what are your thoughts on how investors should be thinking about that? Because like you say, governments need to take action. Civil society needs to take action. Behaviors need to change. This transition needs to happen, and investors have a role to play in all of that, but can't do it on their own. What do you think how should they be approaching that?
I'll start by, before answering the investor lens, I will put my own hat on and say, as an industry, we need to be a better job talking about climate. And it should be in a more neutral and more apolitical jargon, because somehow climate became so politicized. Now, would I argue that the most innovative companies in America have tried to address climate risk by doing EVs? So if every car manufacturer in America has an EV vehicle, or will have an EV vehicle in the next 5 years, the main purpose is to be clean. I hope you will agree on that statement, right? You don't build an EV just for the sake of it. You do so because you believe that the actual vehicle can have less of an impact on the climate risks and so on. And also, if you just want to set it in cynical ways just to make money, you always think that there's a bigger purpose into it.
More fun to drive in a lot of cases too.
More fun to drive. Some of them have ice ranges, then could be super fast. Yeah. So whomever has a like for that, you have different options. So right. My main point to you is that if you're pragmatic and think about market opportunities and the direction of travel, you should talk about climate in an apolitical way, and in so much of a party lens about is it right, is it wrong, and what does it mean. The problem, though, is that we somehow narrow down the scope to fossil fuel industry against the rest, and we narrow down the scope to negative screening against the rest. And it is such a narrow view of the range of options from public to private, to public and private partnerships, to so many other innovative solutions that are being developed that are trying to solve the same issue. So my call for the industry is that let's be pragmatic. We are transitioning to a newer and a potentially greener economy. It has health implication, has real estate implication if you're just a real estate investor, and it's a physical risk that is palpable. And it has investment outcome ramifications. And what we need, though, is to mobilize capital towards solutions as opposed to debating around the time frame. I don't think that we will switch to renewables tomorrow. I wrote a big op-ed about it, just because renewables are not ready for prime time. That's a given. Now, do I believe that in the next, decades to come, we'll see a shift toward the energy mix in the US and other places? My answer is yes. I do believe it's going to happen, but then it's a timing issue.
So, yeah, I was going to say we're seeing it starting to happen for sure.
Indeed. Yeah. Indeed. The main point I'm making here is that as an industry, we need to be a better job at desensitizing the notion of climate being a party lens and a dogmatic view. And we need to do a better job at focusing on the solutions that creates jobs, that creates opportunity, that address inequality. And ultimately, everybody's a winner if there is that narrative that it's about opportunities as opposed to you're in a bad industry and guess what, you are wrong. And for me, that view lens is creating a lot of anxiety that are not warranted.
Yeah, no, I agree. I mean, I think you've got to point out, or we have to acknowledge that on some level, the fossil fuel industry did have a role in politicizing some of that, I think, in order to perceive but I think you're totally right. We are where we are and we need to move forward. And I think I really like that concept. We've been doing a lot of work in the network around the concept of net zero portfolios, because it gives a long-term frame for investors to think about this, and they can divest if they want, but they don't have to. They can engage with fossil fuel companies and but also just look at all sectors in the economy and what kind of decarbonization pathways they're on. And I think it gives a much broader framework to talk about this and to think about both the risks and opportunities, as you said, integrating climate solution opportunities where there's just great investment opportunities that are also going to help push this transition. So yeah, I think there's definitely a need for a focus on the positive there. Well, Mamadou, we're coming up on time, and as I said, a lot of our hope here is to reach students and people interested in getting into the field. And you gave a little bit about background about your journey in, but what kind of advice would you give to young people, whether they're college students or early career, that really want to get into the whole space of sustainable finance in terms of what they should focus on or steps they might take?
Yeah, so I happen to be an adjunct professor at universities in Europe and in the US, and I love teaching. My dad is a professor of molecular genetics and has two PhDs. So I'm the failure in the family somehow. Nonetheless, I truly believe in the value of education. I see education as an investment and a commitment to long-term, let's say, learning. And nowadays, you actually have in most universities programs that are geared towards sustainability, and they are in different departments. You can do that in the science department, you can do that in the business department, and then so it creates so much opportunities. Now, I believe that as it will become less of a niche expertise, so whomever is deciding to embrace that, my calling will be to tell them, make sure that if you want to pick finance, you are first an investor that happens to have another layer of expertise to touch environmental design or any other elements that you've studied as an add-on. Because at the core, if you were to enter or aspire to enter the field of asset management, the baseline of being an investor will carry you further out in your career path than just being an expert of sustainability. Now, it's interesting because before, let's say, the past 3 years of shift, it was an expertise that had a very high premium in the marketplace, and companies were so willing to hire people with the title of ESG specialist, ESG strategist, ESG manager, CSR, and so on. I don't think that, at least in the US, it happens to be a US audience only, that these type of jobs will be prominent if they only encompasses a description on the specialty. And so what I also would like all the students to think about is that at the core, make sure you have a foundation that is applicable and broad enough that you could use your specialty as an add-on, and then you could basically go through market cycles, because otherwise you tend to be on both sides of the equation. And when the market shifts or things are not on vogue anymore, you may be in a hard place, right? So I studied as a quant, FX trader, hedge fund. I'm a money manager. I have a passion for the field, but also I have a passion for a lot of other sub trends. But my ability to pivot and use that expertise to serve investors has been a blessing in my career and helped me maneuver and go through financial crisis and shift of trends and consumer preferences and all these elements. We don't really control them in our career paths. So broad is better.
Yeah, having those hard investment skills carry you through. Awesome. And just quickly, what universities and tell us a little bit about those programs that you're.
So I'm an adjunct professor at Loyola University, and it's actually, we design a certificate on sustainability.
As sustainable investing, or is it?
Yeah. And then the other one is at ESCP Europe, which is business school in Europe. I'm an alumni of the school. And I also lecture at Wharton University. It's been 5 years now, so it's one of the classes that I have. So these are the three that keeps me. If I leave my, teaching for my kids on weekends, these are already three very intense programs.
Nice, fantastic. Well, people check those out. And Mamadou, thanks again so much for your time. Always great to connect. Thanks for the great work you're doing out there, and hopefully we'll talk again soon.
Yeah, my pleasure. You can have me anytime.
All right, thank you.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.